Good afternoon, everyone. In today's video, I want to use three simple indicators to take you through two different patterns. Both are overbought, oversold patterns. One I think is a little bit more heat-free and offers you better trade opportunities. The other feels a little more uncomfortable, but offers you a better risk to reward. Now, the three indicators that I'm going to be using are the following. The first is the scalper volatility box models. The second is the edge signals indicator, and the third is the momentum cross. If you're unfamiliar with these indicators, I'll give you a quick overview as we walk through each one. Now, the two markets I'm going to take a look at are gold and crude oil, and both setups took place early on in the morning before the 8 a.m. Pacific mark. We'll start with gold first, which I think is the easier of the two setups. Now, inside of gold, we had price action breach our volatility box models right after the index markets opened towards the tail end of that hour. 6:30 a.m. Pacific index markets open, gold rallies all the way up into our scalper volatility box models. Now, if you're new to our channel, the Scalper Volatility Box is part of our Futures Volatility Box in which we have 5 different Volatility Box models available. All of these help us figure out exactly where we have a volatility edge for intraday day trading. Scalper is the most aggressive and it helps you do exactly as the name implies, scalp trades. So early on in the morning, we have gold rally all the way up into our scalper models. As soon as we cross this blue cyan line, that's what we call a volatility box model breach. Now, after this happens, we're looking for the edge signal confirmation. That's these red arrows right here. The edge signal is our proprietary overbought, oversold confirmation signal. Think of it as the RSI on steroids, and it tells us that, hey, we're now looking for a reversal here. So in this case, when price breaches the upper models, we're looking for the bearish arrows for a short side trade. Now, the entry for this particular trade we're looking at is at the cyan entry line. The stop is outside of our volatility box models. In this particular case in gold, that was a risk of about 3 points. In terms of our target, first target we're looking for is the same 3 points which we hit in this red candle right here. The second target is the gray target line, that's this line right here, from the same hour in which the trade took place. So if we were to draw this out, this is what the trade looks like. Entry, stop, T1, and T2 with a break-even stop. Now you'll notice inside of gold, we make a very systematic move to both T1 and T2, and what I think makes this setup quite unique is the way that we saw the actual overbought, oversold signals. It's almost like you could just draw a line directly through all of these signals, and each time we saw that signal, we tried to make a bounce, and we saw that sellers in this case defended this level. We saw this price angling almost at a decline. In terms of the second target here on this particular trade, by the way, that's nearly 10.5 points inside of gold, and that's the kind of home run trade that I think most traders talk about, but lack a systematic process to actually get through. Here's that systematic process. Now we repeat the same idea in the very next hour. Now here, gold, after the sell-off, we hit the other side's volatility box models. Now notice here we go outside of the green clouds. That's our sign that, hey, the scalp opportunities are now done inside of gold. We need to switch to the next volatility box model, which is the aggressive volatility box. Now same idea, we breach the cyan entry line, and we're looking for the edge signal confirmation. One more time, we see multiple here, 3, and one more time, it's almost like you can just draw a horizontal line through these levels. Now, the second setup inside of gold, I'll admit, was a little bit harder to participate in, mostly because it was only these wicks which actually gave us the cyan line entry. The risk on this particular trade was also a little bit higher, 5.1 points of risk now that we're no longer on the scalper volatility box. We hit a max move of 9.2 but fell shy of the second target at 10.6 points for this particular hour. So it's the previous hour which hit the T1 and T2. This trade hit only the first target, but same concept with the horizontal line through the edge signal arrows after we see price give us a volatility edge. Now let's compare and contrast this to crude oil. Same time frame, or rather similar time frame with the morning setup. I'm going to come back to the scalper volatility box models, but you should notice something different here. This is the 7 to 8 a.m. Pacific mark. Price action breaches our volatility box models, and we hit our T1 right away. It's almost like price bounces. Now that's the first time we see the edge signal arrow, and now price comes all the way back inside of our volatility box models. Now retests are not valid per our trade plan, but let's continue to observe to see what happens here. We form a lower low and we see another edge signal arrow. Then we see another edge signal arrow continue to form a new low. If you're interested, the difference between these two lows was 5 ticks. The difference between this low and this low was 6 ticks. So it almost feels like sellers are expanding here. Sellers have a little bit more room, while similar feels like sellers are gaining. Then we see the last time that we form a new low, but this time the difference is only 2 ticks. We went from 68 to 66 here, and we see another edge signal arrow. To me, that's the clue that I think we're looking at here. If you were to try and play this, retests are currently not valid per our trade plan. But in terms of trying to find new patterns, as we make lower lows, we see here that it's expanding as we continue to make lower lows, but that suddenly stops, and we see that confirmed with an edge signal arrow. So it would be after this candle that I would be looking at an entry. And in terms of the stop, still outside of the volatility box clouds, but instead of taking the entry at the cyan line, we've been able to cut that risk by just a little bit. So that's the way, if you were to try and get a little bit adventurous to bend the trade plan, I could see you using this overall pattern of forming lower lows, because this entire time you'll see that price just continued to expect and chop around the volatility box models, and it's almost like a rubber band. We had a move take place here in almost two 2-minute candles, which took nearly a full hour inside of gold, or nearly a full half hour inside of gold. So that's the difference between the two different setups. I'm hoping that in today's video, this helped to give you a new pattern to go expand beyond just a trade plan. But gold is the setup, the heat-free setup that very much meets the rules of our trade plan. And I think just a couple visual examples of how you can use this setup for heat-free trades and use the crude trade for ways to reduce your risk on this particular trade feels a little bit more uncomfortable. But again, you're looking for that quick move up. Inside of crude, we hit the T2 target as well, which was a really nice trade, nearly 40 points in the span of less than 6 to 8 minutes inside of crude, all from spotting this pattern. I hope you found this video helpful for all of our futures volatility box members. Take care. If you have any questions, feel free to send us an email. Else, I'll see you in the next update.